Welcome to the Foji's Roundtable, where we deep dive into all things FogoChain and explore the innovations in other blockchains. Join us as we unpack the latest in the Fogo ecosystem. My name is Seb. I'm joined by Dan. We are the Foji's Hub co-founders, and we're also joined by Ian and Teddy from Kairos Research. How are you guys doing today?
Doing well. Thank you for having us.
Pleasure. It's a pleasure because Kairos Research recently released the Fogo Validator report with recommendations on its tech and economic design, which is vitally important because it's a chance to maybe put some of these iterations in, get some feedback before everything goes live, learning from the lessons of others. And in our opinion, it's been very well thought out. And we'd like just to go through all these different aspects. Specifically, we've got some points here to cover, like multi-local consensus, validator requirements, how the network handles incentives and rewards, governance, inflation strategy, and how to ensure high performance from the validators. So maybe we can ask you first, Teddy. Can you tell us a little bit how the multi-local consensus works?
Yeah, so I think we talked about this a little bit, but with Hyperliquid having their validators nodes in the Tokyo data center, kind of hypothetically near the Binance servers, has led to a decent amount of volume that could probably be sparked just from arbitrage and then liquidity from these quant firms and market makers that can trade on Hyperliquid and trade on Binance and arbitrage between those two and make it a pretty good spot for trading. So I think Fogo's expanding on that and doing a couple different things with picking 3 different data centers and following the sun based on volume throughout the day. So data centers right outside of New York, and then in London, and then in Asia, kind of dependent on those trading hours of each day and where the volume within the crypto industry is at any given time. I find it pretty interesting. I think that they also are experimenting with a fallback kind of plan for global consensus. So having more than just one data center, if something does go wrong, they're able to fall back and go into kind of how Solana works as of right now. And it's like any validators that are online and working, any data centers that are online and working, then you can fall back to that as your backup plan. And obviously, latency is then kind of bound by the speed of light, but it's not a bad backup plan. I think we're pretty excited about the experimentation within these like higher performance chains that's happening over the past year.
Yeah, we're also very, very excited about that. And obviously, like with Tokyo's the data center, the first choice. There's no surprise. Backpack also probably located there for all this price discovery and arbitrage opportunities. But like what we really like about Fogo is really that the ability to look at what others are doing and just like building on that and improving it. And I think these 3 core primitives that were established as a result of that were pretty cool. So starting with the follow the sun model that you were explaining, to have these epochs every 8 hours falling liquidity. But then there are other 2, which is the curated validator set. So making sure everyone's highly performant so the blockchain can follow. And then everyone basically running on the same software to avoid that. There's not control of what goes wrong. Do you want to expand, Ian, on the second point a bit?
On the second point being
the curated validator set. So the whole like tech and stuff.
And so Jim at home in his mother's basement, he can't run a Fogo validator.
Well, not right now, but I mean, ideally we want extremely high performant and capable operators, running the best hardware in the most important data centers around the world in terms of co-locating to other like financial and economic hubs, where the majority of like global trading at that time of day is taking place. And this is ultimately how you get like the best user experience, in our opinion. Like, I think that's largely why people gravitated so much towards Hyperliquid as a product, is because it was the first kind of on-chain product to deliver that sort of centralized exchange-like experience in terms of speed. And likely, like that definitely, helped port over a lot of actual volume in terms of people that are trading there, both retail and market makers alike. But for Fogo, it's like we're going to be going even faster. We're going to be doing 40 millisecond block times, and the only way you can really do that is with the most performant client in crypto, which is the Firedancer client. Every single validator on the network will be running this, and they'll be running the latest and greatest hardware in the best data centers around the world. So ultimately, this will translate just to a better overall user experience.
And you said in your
And-
research report you gave the recommended requirements for a validator, and then I guess the base, what it kind of works with. Did you want to go over that and just like, and why I guess it's so important that it's like that? There'll be some people out there that will say like, they want to run it on they want to run something that contributes to the network on their gaming PC, and just like how it's just not possible to do it any other way. You have to have this level of tech.
Yeah, absolutely. So I mean, that is one of the kind of the trade-offs that I think Solana took in general versus Ethereum. So like Ethereum's whole vision was like, anyone can run a node on like a Raspberry Pi around the world. And then Solana kind of beefed up those requirements, and ultimately like performance was enhanced pretty greatly. So what we are looking at in terms of our baseline requirements that we recommended is essentially in line with what we've seen be optimal for running Frankendancer on Solana right now. So a little bit beefier of a setup than just if you're to be running the kind of classic Agave client, and then also tweak that a bit to see what exactly is working great on testnet right now, and just kind of change that a bit. So one of those small changes was just like a slightly larger disk, just because like with 40 millisecond block times, and you're going to be getting like pretty insane state bloat if you don't have like enough actual kind of disk space there. So that was one of the main ones, and then another one was just making sure that you're actually not using like a CPU that's too powerful, because we actually have seen examples of that where after a certain level they actually get like kind of hit on performance rather than it continued to benefit, which is kind of interesting. But yeah, these are the recommendations we've seen from successful operators that are running Frankendancer on Solana right now. And we decided this is kind of the best way forward.
Nice. That's interesting that if you go for too fast of a processor, you have issues.
Yeah, I think that standardization, like day one, is going to be super important here to be able to measure kind of performance across the smaller validator set. And it's like there's going to be a lot of improvements pushed in the network, and being able to say, okay, everybody's kind of running on the same specs. What's wrong is a lot easier than anybody kind of doing as they please and trying to herd cats and figure out exactly where the issues are and kind of who's causing any degradation in performance. So I think like having a decent set of standardized rules and guidelines is going to be pretty important early on.
No, that makes sense.
Yeah, indeed. It's sort of like the word standardization is key, in it what's really differentiate, because we know with other chains you're only as fast as your lowest client. So if you standardize everything, that's a way to make it smooth. And I was wondering, like, obviously running a validator is an important and costly operation. But at the end of the day, it's all about making Fogo Chain highly performant. But how do you manage the balance with sustainability in the long run, also for the validators?
Yeah, so I think the ultimate thing is you need to make the network valuable, right? Because like the validators themselves are taking commission in the native token. And so like the incentive is, of course, for everyone to just like, ensure the network is, as valuable as possible. So the immediate way to do this is to create like a fantastic user experience and something that's like unparalleled against competitors. And with 40 millisecond block times, that will be the fastest L1 in production. And this will ultimately deliver the best trading experience we believe, and also being close to those financial and economic hubs, we think taps into a whole new audience there. So I think that is the kind of primary aligner there in terms of sustainability. Is I think a lot of networks kind of just like um, look at, especially from the validator side, we'll just kind of look at like, how much do I need to break even? How much do I need to like stay afloat? You see this a lot in like Cosmos chain forums if you ever unfortunately find yourself there. But a lot of them are really not too concerned on the network itself. They're really concerned about like their operation staying afloat. And they're kind of missing like, the forest for the trees. Like the real thing that you need to do is just, make the network valuable. And there's a lot of other ways that you can do that outside of just like creating a great user experience. Like I think that is something that Hyperliquid has done quite well, of like actually putting a lot of attention back towards the token. Because ultimately, like the token serves as the primary incentive to kind of coordinate everyone's actions, and you're seeing great examples of that being true, both through like HIP3, which is essentially for like launching proprietary markets, and then also for their canonical stablecoin, which they famously auctioned off a couple of weeks back, and essentially got every stablecoin issuer willing to give up 95% of their net their like profit margin there. So clearly there's some power to coordinating an entire community around like one token. And so in terms of sustainability, it's like those are the two things we look at primarily, is like one, make the network valuable, make people want to like have some skin in the game with it, and ultimately like the best aligner we've seen is through like token value accrual. So a handful of ways to do that, and I'm sure those evolve over time, but that's kind of how we think about sustainability for L1s.
Yeah, you mentioned, you can't see the forest for the trees, and that's very much to the point. So essentially, making the best user experience, as it's a super fast chain, thinking of ways of value accrual. And on that, you had a few points in your report. Perhaps, Teddy, do you want to give us an overview in terms of where you see the token in terms of value accrual? And essentially, what that means also is that you want to promote use, holding, and staking the token.
Yeah, I think this is almost kind of a circular conversation to what we just said as well. Like, if you make the network valuable, then the validators are going to be sustainable. And I think that is vice versa, where people are going to want to stake if the network is valuable because people are using it. So it's like if there are a bunch of transaction fees that are either burning the supply of the token or going back to validators, like either way, I think that one, it drives people to buy and stake, but the other one, it obviously drives people to own the token. So I think that, again, transaction fees, whether that be through kind of standardized gas fees or through like maker taker fees on the perpetuals exchange, like I think either way, it's like the more people you get using the network, it's just good for the token. I think inherently it kind of circles all the way back around to there's going to be demand for the token, whether it's the validators who are running it and seeing exactly how many people are using it and paying transaction fees, or if it's other people that are like, oh wow, I'm using Fogo and I'm paying enough in transaction fees, I can see how the system's going to be valuable. Like I'd like to own the token. So that's kind of how we think about it.
And do you have some sort of inflation schedule in mind? Did you want to go over that?
Yeah, Ian, you can handle this if you want.
Yeah, sure. So yeah, the inflation that we're looking at, well, I guess kind of like to frame it first, like what we were looking at in terms of how to decide this was looking at a lot of other L1s today. We think a lot of those have far too high inflation for far too long a period of time. So example for Solana, like when Solana launched, it would take 15 years from it at Genesis to reach its like terminal inflation rate of 1.5%, which frankly we think is like just far too long. And like during this time, it's like, if you have locked tokens, if you're an investor, if you have like a bunch of other things, like you're still able to get like staking rewards on these things. And this was kind of first, I guess, like the light was shed on that issue around like when Celestia launched. And I think people kind of, especially attacked that because it was a DA layer that was, valued at like $20 billion, and people are selling like locked staking rewards, and obviously that raised a lot of flags, and I think kind of like shine the light on the issue that like inflation has a lot of like negative externalities. And so what we were thinking about when designing it for Fogo in terms of our recommendations is we do think like that initial year is important for bootstrapping a lot of users, rewarding early people. And so like I think a 6% inflation is pretty modest. But then we want to have the decay rate to be like quite fast. So year 2, we're looking at 4% inflation. And then on year 3, that's when you reach the terminal rate of 2%. And we could even make the argument that a 2% terminal rate might even be too high. And you can see that in some of the charts in the report, where like after a certain amount of time, these things do compound quite heavily. So
Can you describe what is
these are just
what is a terminal rate for our viewers?
right. So the terminal rate is just essentially what the inflation will be indefinitely. So after it reaches the terminal rate of 2%, it will continue to be 2%. And then the way that we look at really kind of like evolving the economics there is essentially trying to make sure there's enough network activity to offset the issuance in some way. I think obviously Solana had its kind of moment with like SIMD 228, where they were looking at really kind of changing the inflation from just a kind of fixed schedule there to more of a kind of market-directed emission schedule, depending on the amount of total stake. And ultimately, we think that was a good thing. We voted yes for that. And now that kind of seemed to be tabled. But these are kind of the things that we took.
Yeah, Multicoin Capital, they were behind that. And they didn't put out the information very well. It just wasn't really clear as to the incentives. I think maybe that's why it wasn't passed. But now it's certainly, like as you said, it's very apparent. It's very apparent that it is far better to get down to these low rates.
Yeah, and to put it into perspective of how big inflation is on Solana, that Forward Industry DAT, which raised 1.6 billion, and essentially bought all of that, sold on the market quite quickly. That was 20% of annual inflation. And like $1.6 billion is like a lot of money. Just for for context there, like, and that's kind of crazy. Like that, even like massive DATs coming to market, buying SOL on the market is only offsetting current inflation by 1/5. So it's definitely a thing that I think Solana will have to revisit soon, and it kind of ties into like that whole conversation of token value accrual.
And I guess it proves the point again of Fogo, which is like another opportunity, being able to design this from scratch, realizing what others like perhaps didn't do so well. And it also shows that Solana, like, it's been great for Web3 in general, but it's reached a point that they can't even change inflation. It's a discussion that's been going on for quite some time, and it wasn't approved. So Fogo can fix this from scratch.
I do think Solana or any any of these blockchains, they can put a new proposal out. They just have to understand how to give all the data. But I agree with you, Dan. Essentially, Fogo doesn't have to learn a lesson. It's already been learned, and now they've just got the add benefit of someone else has made a mistake, like all the other blockchains and decisions before it, and you just culminate in this point where you can just go ahead.
Yeah, I think there's definitely some nuance in the inflation discussion too, because obviously part of inflation is a commission to validators, and that's kind of the real dilution of the network. It's like that's what you're paying for economic security, while the rest of it's going back to stakers who are already token holders, which could almost be thought of more as just like a stock split. It's like, okay, sure, the token's not worth as much, but you have, or like it's not worth as much, but you have more of them, and so that your value has still gone up. So I think it is kind of balancing a few different variables with validator commissions and how high those are on any given network, and then as well as the inflation that's going towards these validators. So I think generally for simplicity, it's nice to have kind of a way to model that out, saying, okay, this is the inflation, but here's the actual dilution, and not have that changing forever, but have the ability for the network to kind of vote on switching some of those parameters too.
And can you tell us about the benefits between a 1% terminal rate versus a 2%?
So at a 1% terminal rate, you would essentially like there's first of all there's pros and cons to each. 1% terminal rate, essentially, we would view that as perhaps a bit more sustainable, but it's all really kind of dependent on like how much actual economic activity is taking place on the network. Like no matter what, I think lower inflation is usually a good thing. And then especially like a 1% terminal inflation rate, like that would um, obviously compound much slower over time. Like so when you're looking at like, 50-year time horizon or 30-year time horizon, it's going to look a lot better than a 2%. And you can actually use our economic model that we created for this. Like we made it public so anyone can just like make a copy of that Google sheet, input their own variables there, and you can actually visualize for yourself and kind of see like how different decay rates look, how different terminal inflation rates look. But we viewed 2 as a good starting point, especially because that's an extremely aggressive like rate to get to within just 3 years. Like I don't know of any other chain that's getting to their terminal inflation rate that quickly. But another thing that's important about like bringing down the inflation is actually encouraging people to use their Fogo on chain, because right now it's like if you're so we can look at Solana again, for example, like staking APY is around 7% on there, and so like the LST penetration rate is actually like pretty low compared to a chain like Ethereum, where the APY is much lower. It's now sub 2% thanks to some of those DATs that have come online and staked all their ETH. And we believe that like lower inflation actually is kind of a forcing function to push people on chain and get them using their tokens there. And that's ultimately what we want, especially like year 2 and year 3 and everything else beyond that. Because like we do think for any network to be successful, you want like the core token to be used quite a lot.
Right.
It's kind of an interesting concept, I guess, with traditional inflation when we're talking about like fiat or dollars. It's like inflation encourages people to spend. It's kind of the reverse in crypto, where if there's too high of inflation, people are like, I'm just going to stake and do nothing else. So it is a pretty interesting concept there. But you see it with changes to those parameters affecting how people actually behave on chain too.
Mm. Yeah, no, that's a very good point, how they're reversed. And then also, I'd never thought of it like that, Ian, how essentially someone's going to hold Fogo on a normal centralized exchange unless they can learn that, they're being diluted, so they have to move it onto a blockchain in order to learn. But specifically, why do you think so? So if someone's going to learn more about using the blockchain as intended, which is fantastic, and they would move there to get that 1 or 2% extra staking rewards. Why would they like? Have you seen it in the data on a say Ethereum of people actually doing that because the rates went down? Is that what you've seen?
So what you essentially see is like a direct correlation with inflation or staking APY going down and the actual amount like LST network penetration continuing to go up. And obviously like there's some correlation there because the more people that stake, the more like compressed the yield gets. But also it's like that's the best way now that you can get like return on your ETH is like you're taking it into LST form and then you're supplying it to a money market like Aave, which has, I'm pretty sure, like in total supplied assets, like north of 20 billion. And a lot of that is in LSTs and LRTs, so which are really similar. But essentially just kind of getting more people on chain doing that. I do think the actions of users on cheaper, more high performant chains like Fogo and Solana will look different from just kind of ETH, which is slow, and a lot of people don't use it for trading. They use it a lot for lending. Like the largest DeFi protocols on ETH are, Maker, Spark, Aave, and all of those are related to lending in one way or another, whether it's just through traditional money market or like more of a like CDP style protocol. But I think ultimately, actually getting people, on chain using these things for different things, we'll see what those actually are. I assume they'll likely be more trading focused, because that is just kind of what we've seen with Solana so far. But I think it will essentially just be able to speed run kind of Solana's evolution there as well, in terms of bringing that staking rate down and kind of pushing more people onto DeFi protocols, whether they're there to just kind of loop leverage their Fogo, or to actually use it for entirely new use cases that we can't even think of yet.
All right, that sounds
And
exciting.
perhaps still on the liquid staking. So it is an opportunity also in another perspective, which is like liquid staking is probably the easiest entry into DeFi for those that don't understand. But then it's about, like, as you say, taking the next step. And on a chain like Fogo, Solana, it's just much more cost effective and easier to deploy. But in terms of your report, we also saw that you see some additional utility around LSTs, in particular around validators. Like, how do you see that operating?
Yeah, so I think one of the things right now that's kind of hard for LSTs on, let's say, Solana, is a lot of these are run through stake pools. The largest of which is Jito, and I mean, I can tell you firsthand, Jito puts a ton of effort into making sure they're selecting the right validators, and there's a constant game of cat and mouse being played with trying to make sure you're not letting validators into the stake pool that are participating in any sort of like malicious MEV, um, and making sure you're also keeping like the most performant ones in there. So um, they use essentially like an automated program called StakeNet, which looks at a ton of data, tries to make the right choices, but ultimately with a smaller, really well curated validator set like we'd like to see on Fogo, um, you're going to have the same standards across almost, essentially all of your validators, because they're all in the exact same, location. They're all using the exact same high performant client. They're all using the, very performant hardware. And they all have like a fixed commission as well. So it just kind of makes it easy in that sense. And we believe like it makes the idea of like spreading stake across those validators uh, a much easier job than you see on other chains. Like, um, it shouldn't be a headache to delegate stake, and I think Fogo will probably be the easiest chain for an LST to actually delegate that stake.
Yeah, I guess that's, yeah. When you build curation into the DNA, then that just becomes like the standard again. So you don't have to worry so much about those bad actors. Definitely an interesting take there. And the second thing is the 10% commission. I believe in Hyperliquid that's not set in stone. So it sounds like that's an opportunity to avoid like a race, an unfair race to zero commissions and what and all that can bring. Anything
Yeah,
else
yeah,
worth adding there?
I think fixed commission was a bit of a bold bet on our side, but I think ultimately there's a lot of reasons to vouch for it. And like you were saying, like on Hyperliquid, it's not a set thing. You will see on other networks there might be a minimum inflation, or in some cases a maximum as well, like for some Cosmos chains. Um, but ultimately, those validator ecosystems on those chains, they're not competitive. We do believe like the two most probably competitive environments for a validator are both on Solana and Hyperliquid, and neither of those has any rules really around commissions. The only one that is on Hyperliquid is that you can't increase your commission after you've set it. So if you set it to 10%, you can't next month be like, well, I'm going up to 11. You can only kind of go down. And so this kind of caused a race to the bottom over there. So just to kind of put it into perspective as well, like, Galaxy recently joined the Hyperliquid set, massive like financial institution, not even just like a crypto company, but like a massive, Wall Street financial institution at this point, brought on around like 50 million of hype. And I think in total, based off their commission, which is the second highest on the network, they'll be making around 80K a year. So, I mean, these networks are, these like races to zero might not be the best incentive structure for validators on the network if they're not really making that much on their rewards. Now, if like their principal amount they've staked goes up because the like value of that has increased a ton, that's great. But commission can also kind of create a lot of different games. And we're seeing a lot of those being played right now on Solana, for example, with newer validators that are coming onto the set. Like we joined the set in January of this year. And so we're quite late to the game, honestly. And so we got to see firsthand how difficult it is to really kind of, get the right amount of stake and, get into the right stake pools and find the ways to get delegation. And essentially what you're seeing in terms of like the top 100 and bottom 100 validators on Solana are two very different things. The top 100 can really benefit from economies of scale, where say if you're a Binance and you have access to, a bunch of like retail users that just want to stake their soul, don't want to go on chain, kind of like what we were talking about a bit before, like that's how you become the largest validator on the network. And, like that's exactly what Binance has done. Like they joined not too long ago. I'm pretty sure they joined at some point last year, early last year, to my understanding, or maybe a little late in 23. But they've become the largest validator on the network, and they can benefit from economies of scale. So it doesn't matter what their commission is, doesn't matter what their MEV commission is. Whereas if you're a new validator coming on to the set, you're very, very sensitive around your commission rates, and you almost have to go like to 0.0 just to be able to get into some of these delegation and or stake pools and receive delegation that way. Or if you're trying to attract new delegators to your validator, you're usually having to continuously lower fees over and over and over. And so what this has resulted in is essentially like a lot of the top validators kind of consolidating a lot of that stake. And then because of this, now they're able to essentially get more leader slots on every single epoch because it's a stake weighted thing. And so it's just kind of this, if you play this game out long enough, everyone will know how it ends. Is you're going to end up with your own curated set of validators just by market forces. And we aren't sure that's the best incentive. And we think like a fixed commission rate kind of keeps it even in that sense and can create a lot more of a level playing field while maintaining optionality for the network in the future if they are to ever like decide to expand the validator set or to play with that commission rate at all, whether to get rid of it, increase it, decrease it, things like that. It's just another economic lever in the toolbox for Fogo.
Yeah, that makes a whole lot of sense. It really does. It's probably pretty alarming. I'm not sure how many of the top validators now could essentially, take over the network. I'm not sure if you have that information to hand, but you are right. It's just concentrating in the few, and then if there's no changes made to Solana in the near future, it will just get less and less validators. And in addition to that, it's already quite expensive to run a validator on Solana. So I guess it just centralizes even further. I guess what has been said is it's a decentralized network, but ultimately, how decentralized is a network if, in 5 years' time, it's just going to be less and less validators controlling that network?
Yeah, exactly. And it also
the concentrated stake discussion.
Totally. And like it also kind of does push those smaller validators then to, realize they can't compete, and then maybe start doing some kind of malicious MEV, participating in private order flow, like kind of private mempools, these sorts of things. So that's another thing that can be easily avoided if you kind of maintain that ubiquity across the validator set in terms of commission.
Another interesting topic for today, I'd say it's the native stablecoin. And I say it's probably an interesting topic as it's a discussion that Hyperliquid postponed. It wasn't a priority for them at the beginning. It was seen as just as a percentage of the overall revenue. But suddenly there's been a lot of discussion and a lot of interest from several players. Do you want to touch a bit on how Fogo can think about the stablecoin and how it adds value to the token?
Yeah, I think it's all theoretical for Fogo right now, but I think that you see what kind of power you have when you're able to build a platform that enough people want to use, and then all of a sudden you have, like Hyperliquid did, $5 or $6 billion in USDC, and you're sitting there saying, "Wait a second, why is Circle earning all of this interest? I'm the one who built the platform that people deposited $6 billion into, and that people actually want to use." And then they said, "Okay, well, we're going to pull the lever and say, in a sense, we'll either build our own stablecoin or someone will build it with more favorable terms for us. How are we going to do that?" And I think that there are a lot of people that were willing to say, "I'll take 5% of the net revenues and be the provider for this, because this might be somewhere that has 10, $20 billion in deposits easily someday." I mean, if you look at Binance, I think they have 30 billion in USDT or something sitting on the platform right now. So, like, if you build a successful exchange, you can get billions and billions of dollars, and with shorter term T-bill rates at 3 or 4% and not passing that back on to the users, it's like, that's a lot of money. So I think inherently Hyperliquid's like, let's drive that back to the platform. I think the two ways you do it are either the depositors should get that yield pushed back to them, like the people who own stablecoins, or it goes back into the platform and Hyperliquid will use it for buybacks, like hype buybacks. So I think that both of them are interesting, but you get a lot of optionality once you build a successful platform.
Yeah, so I guess it ties back to what you're saying at the beginning. It's like, it's all about building a great on-chain trading experience, growing those network effects, and then you'll just have something to decide on. So either redistribute to the holders, to the depositors, or just like inject directly to the token through buybacks.
And is there some sort of legal pushback on giving the yield to the depositors?
There are strange rules with, like, US stablecoin rules on how you're not allowed to necessarily pay out interest to the holders themselves, but there's ways around it with paying rewards. And I think, like, again, you've seen that with like Circle and Coinbase. Circle's not paying any interest out to the holders of USDC, but Coinbase, who has a joint venture with them, is paying out rewards, which is effectively just from the interest of the. So I think that there are ways around this. I think that PayPal has kind of also looked for ways around this with PYUSD, because people that own enough stablecoins are like, why am I not earning the risk-free rate on this? So it's tempting to be like, we need to find a way to drive some of this back to the people that are actually holding our stablecoin. Now, obviously, Tether probably likes to capture that whole spread and have the net interest margin be 100% of what they're earning on. So I don't know exactly what the end game of that is. And if you build a stablecoin that enough people want to use for payments, then I guess they're not worried about earning interest on it. So I think there's going to be a wide range of stablecoin choices in the coming years. But I do think, again, if you build a successful platform, there's a lot of ways to drive value back to the token. Even if you don't see on day one, okay, this is all going to buybacks, that doesn't necessarily mean it's not a valuable platform.
I think my personal preference would be for like FUSD to generate the yield and then that to go to Fogo in buybacks personally, as opposed to having to work out all these extra things. But that's just a personal preference, and there's probably another side which will be presented in the future, which would make it maybe heavier on the other side. But either way, I definitely am not happy with the fact that just for the connection or the network effects of using something like USDC or USDT on a network means that Solana and all these blockchains that are doing well end up giving hundreds and hundreds of millions of dollars, which ultimately go to Tether or go to Coinbase and Circle, that then go to Base and fund their little EVM or their big EVM over there.
100%. It's a great discussion. I think it's an ongoing one. There's been a good amount of feedback from the community. And perhaps before wrapping up, just wanted to leave like a suggestion for the Fogel team, which is naturally there's going to be this geographical location starting with like 3 zones. And one of the things, because we don't know the details, is in the case that, let's say, people have to stake for a specific validator in a specific region as opposed to like globally, perhaps the Fogo team could think about any potential economic security imbalances, sort of like if some areas have less stake APY, so the yield will be higher, but there will be less economic security. Naturally, this is an ongoing game, but perhaps we could like repurpose LST stake automatically just to cover up those imbalances. So maybe that's something for the team to think about.
Sounds good. Sounds necessary. Well, thank you very much for your time, gents. Your research report was a fantastic read. It's linked below as well. And any closing thoughts you have?
Yeah, thank you guys so much for having us on. I guess like just a kind of one call to action. If you do want to, check out the research report, and then also for the kind of like inflation models, the Google Docs is linked in there. You can go and mess around with it yourselves. And yeah, we want everyone kind of contributing to these ideas. We think that's how you get the best outcome. We think that's like a superpower of crypto, is really opening up the floor to anyone. And yeah, so just really want to get continuous feedback on that, not just now, but like, always into the future as well. And thank you again for having us on. It was a great discussion.
It was our pleasure. Thanks again.
Thank you, guys.
You both.
Take care.